Welcome to the Live Squawk podcast, where professional traders, investors and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Before we dive in, if you want the news that moves markets delivered in real time, 24 hours a day, check out Live Squawk. It's our audio squawk service trusted by serious traders worldwide. Start your free trial today at livesquawk.com. No credit card required.
Good afternoon, good morning, wherever you are. Hello and welcome to Live Squawk's Market Talk, our weekly review and preview of all things financial markets. Today, on Monday, 18th of May, 2026, it's a different day today, doing it at the start of the week as opposed to the end of the week. But we're still going to review last week's data and key events. And this is for anyone new to this, is our weekly briefing aiming to break down the key stories from the past 7 days and explore subsequent implications for the markets. We'll also look ahead to what's coming up and give you a heads up on the events and data points to watch out for. Before we bring in our guest, Ryan Livingston of Forex Analytics, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research before making any decisions. Consider your financial objectives and consult a qualified financial professional. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And with that done, we'll take a look at the week gone, the week that was, to see what we can see. Right, I've got US CPI and PPI data that we had out start of the week, early part of last week. What are your early thoughts on that? I mean, we saw obviously CPI come in with no real surprises. I think the surprise was really on the PPI, and I know you said and referenced PPI before and said it's probably the one we want to watch out for more so than the CPI reports generally at the moment with everything that's going on with the Middle East. So what did you make of the inflationary data we saw, or inflation data we saw last week from the US?
Yeah, good morning, mate. It was to be expected, really. I mean, we got a small inkling of the March data, what was coming. April was obviously the first full month into the conflict, and we start get the data, and it was hot inflationary data. The only surprise I could say about the US data being so hot is that I thought they might be a bit more insulated from some of the price rises rather than Europe, obviously geographically wise, Europe being closer to the conflict. But obviously there's a lot of energy stuff in there, and that's going to affect anyone. So on one hand, it was a little bit surprising. On the other hand, it wasn't. I think it's the start of things to come. Depending on where oil prices go over the next few weeks, we're already, 18 days into May already, and they're still elevated. I don't think that data is going to get better anytime soon. But the real question now is how quickly is all that going to feed through into some of the core measures, because that's the stuff that the central banks are going to be really interested in. And, the likes of the ECB all talking about the second round effects. And it's still all on the clock. The longer this goes, the more that headline inflation is going to feed through to the core numbers and give the central banks a decision to make.
Yeah, and do you see that coming sooner rather than later as a decision making? I mean, from what we read and what we hear, obviously President Trump made threat isn't the right word, but suggested that unless the Iranians start to move forward on the current talks, then bombing and the conflict could resume anytime in the near future. And we've heard that before. The taco phrase that we've heard before. He stretches his out, kicks the can down the road, and it's that uncertainty, I guess, that won't help inflation expectations on one level, but doesn't seem to be undermining the markets on the other. We seem to have we're in this sort of a holding pattern, it would seem, for the markets at the moment. Would you agree with that?
Yeah, well, I think particularly the end of last week, or a lot of last week and coming into today, I think we're seeing the Iran risk trade coming back in force. We're seeing the dollar strengthening. We're seeing oil, as I said, higher. We're seeing stocks coming off now, off the highs. I think we got over the bulk of the earnings from the US or earnings season. We got over the Fed. We got over all the big data, NFP and whatnot. We've seen the CPI. So really the market's now, well, what are we going to trade next? And we're back in that Iran thing with Trump raising the rhetoric again. And I think for central banks and when they act, to put a time on it, I'm looking at June. If we cross into June and this thing's still going, then they'll be forced to act, particularly the likes of the ECB. I mean, even some of the members have said, if things aren't resolved by June, we're going to have to act. And I think we've got to listen to that, because I do have some sympathy. They're caught between a rock and a hard place. If they hiked this month or in their last meetings and the thing ends tomorrow, they potentially hiked for no reason. So they want to be sure about it because they got caught with their trousers down way back in 2021. And they're fearful of that. So I think, if we're into June, that's when we get the next big batch of central banks with forecast meetings as well. I think that's when they'll have to at least do a little piecemeal hike, I think.
Yeah, but I mean, getting my head around, especially, I know we're going on to we're more on the ECB, but the same applies for most of the central banks, is you start to act, and even if it ends in 3 months, how effective will that single hike, I'm being presumptuous, a single hike actually be to, one, keep a lid on expectations, inflation expectations, but two, have a meaningful effect on the economy to maybe, just damp down the heat? That's my problem, I think, with all this.
Yeah, and that I've said it in the very first week when it kicked off, the week of March the 9th, when it all kicked off, and everyone's like, "Oh, inflation's coming and we're going to get rate rises." I said that is absolutely the wrong thing to do, to raise rates, because you're not, when you've got oil going through the roof and the dollar going through the roof, it's a double whammy, and Japan's feeling that immensely. And hiking when you've got low activity is not going to work. You're just going to crimp activity anymore, and you're not going to change the price metrics at all of importing energy prices. I'm no economist, but in this situation, they'd probably do better to cut rates, to give the economy that easing measure and that assistance to navigate through higher prices that no one can do anything about. But I'm not a central bank. They have to be seen to do something. It's still fresh in the mind what happened in 2021 when they were late, and they can't afford to be seen to be late again, even if it's the wrong move to do. And you're right, 25 pip hike won't make any difference, and that's what they can hide behind. Oh, we're doing something, but under their breath, well, 25 pips isn't going to do anything anyway. So it's sort of, in their eyes, the best of both worlds. But what that might do to weaken the economies further is what we have to be seen. And I think that's, particularly for the UK, that's going to be a big issue.
Well, again, I think it goes back to this credibility thing, because they lost credibility with what happened in 22. Sometimes the best thing is to do nothing. We say this in trading at times, is like sometimes the best thing to do is sit on your hands and wait it out. And I think if we hadn't had 22 and the mismanagement of monetary policy on a wider scale, we're not talking about just the US or the Europeans, but on a wider scale, because it was that collective thinking, I think, that got in the way with, I'd say G7 central bankers predominantly. They would have that bit of room now, I think, and a bit of confidence to just go, you know what, no, we can see where this thing goes, and be a bit more sort of, do you agree?
Yeah, exactly. And then we need to be clear, it's more the market getting more hawkish than the actual central banks. Even the Bank of England, to their credit, have said, we need to be careful about hiking. It's not just a dumb thing that we're going to hike because inflation's coming higher. They recognise that we have got a weak economy. We haven't got an economy that can wear 2-3 hikes because it's going to do more damage. So they are trying to be a bit smart, but like you say, the credibility, if inflation's back up at 5-6% and the government screaming and shouting and people are screaming and shouting that rates are up, and everyone's going to go, well, what's the Bank of England doing? And if they go, well, we're not doing anything because we don't need to, they're going to get it in the neck. Yeah. So it's that rock and hard place. And the problem they've got is because of what they didn't do in 2021, like you say. If they
Yeah.
done it properly, then they would have given themselves enough leeway this time around.
Absolutely. I want to move on to the retail. We had retail sales data out as well last week, the April flash reading. It shows some resiliency in the US consumer. That's no surprise. We've seen the resilience of the US consumer over the past, I'd say, year, 18 months, really. But at some point, higher gasoline prices and food costs will start to chip away at that consumer sentiment and consumer confidence. It doesn't seem to be at the moment. But I've got a note here from Barclays that said, we think that today's rise puts consumers on course for a 2.2% quarter over quarter since the adjusted spending gain in Q2 of 26. That's astounding considering where we were at the end of February at the start of this war and the price of oil, a barrel of oil at the time. I haven't looked at the savings rate lately, but it's something that people refer to from time to time about the diminishing savings rate in the US. They've got even less reason, I guess, the central bank, as we've just discussed, really to want to jump the gun. Would you say on raising rates?
Yeah, absolutely. And we've been mentioning it on this show for months. Their inflation never came down, never got down to their target. And in fact was starting to rise again even before the Iran stuff kicked off. So they had, I wouldn't say call them problems because they've got a decent economy to go along with it. And yeah, again, you're thinking, okay, this is going to cause the US economy to roll over. We've been saying, could that have been a possibility for the last year, 18 months? And it still didn't happen. Even the jobs market, we've had a couple of wobblers. It's come lower. And now we're posting triple-digit gains again in the NFPs. So every time we go, the US is going to roll over, it doesn't happen. And they've got, therefore, that activity, that growth. If they do have to hike, they can wear it better. A 25 pip hike will probably not make a difference in the grand scheme of things, but would potentially, offset some of the inflation without damaging the economy too much. But I think overall they're in wait and see mode. They certainly don't need to hike. The question, obviously, now we've got the new guy coming in, Walsh, is how long is he going to go before he can cut rates? Because based on
it's almost the opposite question.
Exactly, based on what's been happening, particularly to inflation and the jobs market, he's got there is no reason to cut rates at all. There's more a reason to potentially raise rates, not just on the Iran situation, but on inflation going forward anyway. As I said, because it's been higher and moving higher even before the Iran thing kicked off. So he's got an envious task when he sits down, and we should probably wait for some truth bombs from his nibs.
Yes, absolutely. I want to move on, and I'm going to connect this with the yields that we've seen, and we've seen a rise in yields now. For the 30-year yields, I think last week we've seen them at highs we've not seen for nearly 30 years, really. Say UK yields, for example, 30-year gilt yields were at some 5.74%, highest is like 97. Obviously, we've got the political scene, and I want to come on to that with the GDP numbers, which were a bit of a surprise. We saw Eurozone Q1 GDP. It was a second reading, so really just fleshing out what we saw. But for the UK and Q1 GDP reading, that came in, I think it was 0.6, wasn't it? And I think on the month we expected a contraction as well, and we saw some positivity. A little bit was dismissed. I think that again we saw this pattern last year where we saw the first quarter, maybe even the first half of the year, look relatively healthy, but then tail off in the second half. Last year was, I think, the tariffs and people just getting ahead of that. And this year, do you think there's any hope that the UK economy, particularly, will see any momentum going into Q2?
That's a good question. I wasn't surprised about the Q1 data. We saw a reasonably decent consumer in the latter part of last year. The PMIs had started picking up. I said, the first quarter we could get some good numbers. From that point on, that's a question. Q2, we might see the first month's data, so April's data, holding up okay-ish. I don't think it's going to be as strong as what we saw for March, or for Q1, because we
And March was 0.3, by
Yeah.
the way. We were looking for contractual 0.1, we came in up 0.3. So yeah, sorry.
and we've got obviously price rises, inflation always impacts us really badly over here. So you only got to look at the petrol pumps to see the impact going on there. I think it's going to start to crimp consumer spending. It's going to crimp activity, although, as I said, we haven't seen that in the PMIs for last month. They were pretty hot, but that's probably on a bit of stocking up and front running or whatever. And then the political mess, it just makes things really hard. I'm not one of these perma bears on the UK, but I've been bearish since last summer due to political reasons and the fact that we had a budget that had zero growth measures in it at all. And I think that's set to continue. Obviously, it could get even worse if we get a leadership challenge later in the year or in June, and how that progresses. So I'm still pretty bearish, but we know the UK, when you get the real bears coming out and claiming doom and gloom, we have a tendency to confound those calls. So I wouldn't be surprised if things don't get as bad as I think they are, but I'll still remain bearish, and I don't think we can hold up the level of growth that we had in Q1.
Sorry, I must remember to press my button. Take a look at the week ahead now. Thank you. I did catch what you said. And I want to look at what we have this week. It's a very quiet. What I noticed is there aren't a lot of Fed speakers this week. We've got Paulson speaking this week, but it's a relatively quiet week for Fed speakers for some reason or another. But we do have a large contingent of ECB speakers throughout the week. So be aware, we're going to hear from Lagarde and Lane, the chief economist, throughout the course of this week. But in terms of the data itself, we've got Japan prelim GDP that comes this evening GMT time, really. Government initiatives have partly cushioned the impact of the Middle East conflict, and likely reflected that in the data. We're looking for slightly better, or maybe sideways growth for the Japanese economy, and we're not going to see any of the deterioration, or it's not going to be degraded by the inflationary pressures that we've seen yet, because they've put in place initiatives to try and help shield businesses and households at the moment over there. But do you expect at some point they'll start to feel the pain? Obviously, they're very reliant on Middle East oil and energy, so therefore at some point that will come home to bite, won't it?
Yeah, definitely. As I said, oil prices going up, price in dollars, we're seeing dollar yen going up as well. So it makes a bit of a sort of double whammy. Although they have got some ships through the Strait, so they've perhaps done a deal with Iran over that front, but it's still going to be pain for them. And yeah, the same thing. I think Q1 GDP should be okay, and what happens in Q2 is going to be affected by the Iran situation and whether that's put an actual crimp on activity. And the real problem they've got is they're just about to do or potentially do another supplementary budget, finance that with more borrowing. That's more weakness for the yen, and I don't see any which way they get out of this spiral they're in with what they're doing and what's going on in the world. Which keeps weakening the yen. We've already had intervention that's done nothing, and I think they're in a bit of a pickle over there in Japan. Bank of Japan hiking isn't going to fix it. They might step in and do some bond buying to control yields, but then that's easing just while you're hiking. So I don't know how that computes. So they're in a bit of a mess at the moment.
Does seem a bit of a bind for them. Okay, we do have PMIs out later part of this week for across the globe, but we're looking at the Eurozone PMIs at the moment. We're still looking for them to stay in contractionary, the composite to stay in contractionary territory. I think manufacturing, though, may be a bit supportive. Manufacturing could come under a bit of pressure, I guess, with that pipeline inflation that we're seeing at the moment. How much do you look at the PMIs, more so than maybe an opportunity to trade, but in terms of how they feed into your thinking about the economy, or your perception of the Eurozone economy in this instance?
Yeah, I think that the PMIs are very important. I know people like to dismiss them, but it is the first insight we get of the new month into what's going on the ground. The hard data comes 2 months later sometimes. So the components, particularly prices paid, prices received, that's very important because we've seen some of the PMIs where input prices have gone up, but firms have chosen not to pass those on, so they're trying to wear them to keep business flowing, which obviously impacts margins. And if we start to see that these firms are now going, hang on, we've got to pass these prices on now because the input prices keep going up. That again is important for the likes of the ECB and all the central banks, because that's what brings the second round effects in again, because now the price increases are passing down the chain. And from that, we have to see whether activity is now starting to be stunted due to those price rises, because no one wants to pay high prices, and it can result in orders. You're only going to order once a month rather than every week, sort of thing, if prices are higher. So that sort of information is what I look for, and then I can feed that into what I think a central bank's going to do. Are they going to hike in June, or what are they going to do? So it is going to be very important. It's also going to be very important to see the differences between the different countries. Who's really, got a problem? Who hasn't?
Sure.
Germany, obviously the big one. If they're going to have a big problem, that's going to affect the whole of the Eurozone, and that's going to push the market moving, whether it's buying the euro or raising rate hike expectations, and we see yields going up and all that sort of thing. So, yeah, on the face of it, the data itself, you take it or leave it, but it's the components underneath that are going to be very important this week.
Yeah, I mean, I know there was a time last year, I think, before they announced the heavy investment, that we were looking at a more evenly spread, not evenly spread, but we were seeing more input from the likes of Spain, for example, and Italy in terms of how much of a part they played in the growth picture. But in your head, it's still where Germany goes, the rest will follow, in terms of growth.
No, I think that divergence is still there. I mean, Spain.
Divergence, that's the word. Well done.
Yeah, Spain's still trucking along pretty nicely. Italy's doing okay. France is still, flatlining. Germany, it's always called the big growth engine. The whole thing might be offset if Spain and Italy and some of the others are growing, and Germany's having a bad one. Weighted numbers will offset, but it's still big. They are still the biggest economy in Europe, and they did have that big spending plan, which was going to be over 10 years or whatever it is. But we haven't really seen anything come into fruition yet. And yeah, if they all start moving in the same direction, so we could get a bad German number and a good Spanish and Italian number, and it, as I say, it cancels each other out. But if they all start moving in one direction, that's going to put pressure on the ECB, because, as I said earlier, they're going to look to potentially hike on the inflation front, but meanwhile their economies are softening and turning sour. So how do they, square that circle away?
Yeah, good point. Right, and then I guess we got Labour data, and we look to the UK now. We kind of, we looked at it from a GDP perspective. Obviously, we're out this week, tomorrow, and when we've got CPI data out as well and retail sales out. So it's a key week for UK figures, really. From the CPI, I guess that's a known. We know what that's going to bring. Obviously, we've mentioned pipeline inflation and factory gate prices, and how they may start to become even more elevated. But I think on the CPI number, we're actually looking for a slight drop on anomalies, really, on base effects, from 3.3 to 3% for the annual rate, with, I think, core looking to tick up a touch, from 2.6 to 2.7, if I'm right. It must be a nightmare if you're trying to figure out what's going on at the moment with the UK coming, with all the political noise that we're seeing as well. Do you stay clear as a precaution, or are these opportunistic times for you as someone who trades these markets?
There's always opportunity in these markets, as you know. Yeah, I've got a bit of a bearish view, as I said, and I'm expressing that through long euro sterling. I'm happy to sit that way at the moment. We're going to be getting April data, so it is a fresh look, and we'll see, as we talked about earlier, whether that Q1 number is going to hold up or not. The jobs market, again, it was looking like it was heading off a cliff or potentially to a cliff edge, but it's pulled back a little bit. Whether we see any of this Iran stuff feeding through and prices feeding through into firms having to cut costs and let go of workers, I think that's the risk from now on, whether it's this data or next month or whatever. So I think that's what we need to look for. Retail sales, again, are these higher prices now putting a crimp on spending? So this is one of these weeks for the pound where we've had times where things look okay and the pound is a dip buy, and now I think we're definitely with this political mess on top as well. I think we're in rally sell mode, and if the data comes out that way as well, then cable could be heading much lower and euro sterling much higher.
Okay, awesome. We are near the end of the show, but I want to stick with the UK themes. I think in terms of, if we're looking at opportunities, we're looking at just cracks in the market and where everything's going. The UK is a prime place at the moment. We're not a political show, but you know, we are interested in what happens at the Premiership level because it affects UK securities. Where do we go with the politics? So Keir Starmer, I think, is a lame duck, and it's a matter of when, not if, he cedes power. And obviously, the machinations of politics can go on and on and on. If we get down to a situation where it's Burnham or Streeting, and some of this has been reflected in what we've seen in price action anyway, but I don't think it's been fully fleshed out. You're bearish on UK now. Do you pile in and just put more on if we get a Burnham leadership, or if we, you know, and there are a lot of presumptions he has to win this seat that's coming up for election. That's, I think, going to be mid-June. Although I don't know if the actual date for the by-election's been fixed, the local election. If he gets in, because he's taken on reform in that area as well. If he gets in, it is an if. Then obviously he will then start his campaign to become the new prime minister. It's a hard one, isn't it, to try and figure out how to play things. I know, you know, you just said the way you're facing on it all, but there are minefields out there, aren't there?
Yeah, absolutely. And to be honest, I was surprised that we didn't get a market reaction longer or sooner than we did. It only seemed to really kick off last week. So I was already positioned for that scenario happening. You know, leadership challenge, maybe Starmer going and whatever. But I think it's gonna ebb and flow. We know, as far as the market's concerned, Burnham is the potentially worst outcome fiscally on top of everything else. So I think we've already traded that. The market knows that. We've got these steps. So we've got the selection thing on Thursday when I think he decides, or officially whoever's going to go in that by-election announces. I think it's June 18th it's been touted for, the by-election. So I think whatever that's going to happen to the pound is going to come in stages. We're over the shock now. Starmer's going to fight it out. Streeting sort of, yes, I'm there, no, I'm not there in terms of a challenge. Burnham's coming out, he's going for the by-election. We still might get some others coming out and looking to run in the challenge. They might be waiting until after that by-election to see if they're even up against Burnham. So I think as far as the pound is concerned, if it's Burnham, gets through the election, puts in a leadership challenge and looks like he's going to win, then I think that's when we'll see the market reacting once again. But probably now, probably see the foot coming off the gas pedal. It was, you know, depending on what other headlines we may or may not get until we get to that by-election in June.
Yeah, I mean, I've got a note from Bank of America Merrill Lynch, and they say that though the threat of a negative market reaction to, say, Burnham is there, it's unlikely that they would breach fiscal rules if that was the outcome. Even someone like Burnham is mindful of the markets. We'd like to think so, and therefore would tread carefully with how he tries to fund the government out, in terms of taxes and everything else. Obviously, I imagine we'd get a new finance minister as well, a new chancellor, with Rachel Reeves so sort of wedded to Keir Starmer as she is, really. So one to watch there. Listen, we're at the end of our half hour, but Ryan, thank you so much for your participation and your insight, and it's always very much appreciated.
Thanks, mate. Always a pleasure.
Awesome. Thank you, everyone, for listening. You can listen back up to the start of this on social media platforms, X and Facebook and YouTube and the like, and also on podcast platforms like Spotify and Apple and Amazon Music as well. So please go back and listen to not only this, but past recordings as well, if it gives you any better kind of insight into the markets and the market mentality from a lot of our special guests. But thank you to Ryan Littlestone of Forex Analytics, who will put up your links to where people can find you.
Thank you very much, mate.
Awesome. And thank you, everyone, for listening. And we'll see you again at the end of the week. LiveSquawk keeps serious market participants ahead of the news around the clock. Start your free trial at livesquawk.com.
Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.